Hello, this is Jordan, and this is your precious metals video market update. Today is Wednesday, March 4th, 2015. And today we're going to look at several markets in addition to precious metals stocks, which we'll get to at the end. But real big picture, when is the bear market precious metals going to end? My theory on that is, I've talked about the 400-day moving average in both gold and gold stocks, but the second big thing is the gold against the S&P ratio and also the gold stocks against the S&P ratio. These things have been in a clear downtrend since the summer of 2011, when the stock market was about an 18 or 19% decline, and at the same time that's when precious metals peaked. And so since then, we've had this clear negative correlation, and we need to see precious metals break out of these downtrends. And until that happens, there's still going to be skepticism in our minds as to, is the bear market over or not? So you can see in this chart, we've plotted those things, as well as gold against world stocks, which excludes the US at MS World Index, and that ratio has been not as weak as the other two, but still there hasn't been a breakout there. So these are things to keep an eye on. And so that means that precious metals are likely going to need the stock market to have a correction. When we're talking about a correction, I'm not just looking at a 5 or 10% correction. I think we need something on the order of 50% or greater. Now, in this slide, we have two charts here. The top one shows how long the S&P has gone without a 15% correction. The bottom one is a year or so old. It shows the number of days prior to the start of a 20% correction. Now, let's look at the top one. So 15%. Now, let's keep in mind that there was a 15% correction in 2011. So that's why, as far as that metric, the market isn't at the kind of extreme it is. If you look at a 20% correction, which I updated there in black, the only two times where the market went further until it corrected 20% was in, I believe, the mid to late 1950s, excuse me, and then in the 1990s, obviously. So on that, looking at the 20% metric, the market is obviously nearing a point where it should be pretty close to having a 20% correction. Now you look at the top, looking at 15%, again, because of the 18% decline in 2011, on that metric, the market is not as overbought. Now, staying with the top picture, as far as where we are in the stock market, I've kind of used the 1940s as a similarity. And if you look at there, where the arrow is to 2010, and those marks there, because there were several corrections, of course, in 2008, and then maybe it happened twice in 2011. That's similar to if you look at 1940, and you can see there's several bars there. And then in 1946, we got a bear market, or you can call it a correction, that was about 28%. There was huge inflation at that time. The secular bull market in commodities, which began in 1933, didn't peak until 1951. So there are a lot of similarities, in my opinion, between today and that period. You know, we had a huge government debt problem. But anyway, 819 days and counting. And one thing to keep in mind is this is without a 15% correction. So that means if the market, let's say it peaked a month from now, and then it took 5 months to have a 15% correction, that 6 months of time, that over 100 days would then be added to this data. Whereas the bottom marks it until where the market peaks before the start of that 20% decline. So in any event, looking at both of these things, that tells me I do think sometime in the next year we're going to see at least a 15% correction. I would guess at some point this year. I don't know if it's imminent, but October is always a right period, and then the whole sell in May, go away thing always comes up. So I think the next after the next month or two, the next 6 months after that, I think that's a period where we could start to see the market have some weakness, at least begin this correction that we're looking at. And of course, that would be positive for precious metals, as we talked about before. Now, this is obviously we could bring up many different types of indicators that are bearish for the market. There's probably some out there that are also bullish, but I think most of the data is long-term bearish on the market. And this one I find interesting because it's a put-call open interest ratio for the OEX, kind of called the smart money put-call ratio. And on here, there's various readings when the put-call ratio was over 2. And if you go back, most of these signals have really been key warning signs for the market. I mean, the only times there was one there in early 2003, and then one, it looks to be in early 2012. Those were the only two that didn't pan out as far as bearish warning signals. And look, at both those periods, the market was coming off of a correction. I mean, in 2003, the market, the market was coming off of a severe bear market. So yes, the market had gone up quite a bit in the last year, but overall, it was still way off its highs. And then in that signal in 2012, the market had recovered pretty strongly, but the market did just have a 20% correction. So that's one thing when you look at these bearish signals. The ones that occur after really long periods of uninterrupted gains and periods where you haven't seen corrections and just periods where you've had a bull market for several years. I mean, we're right now on the 6 years into a bull market. I mean, when you get bearish signals at that point, I mean, they tend to be really stark warning signs, in my opinion. Now, another thing to keep in mind is obviously happenings in the currency markets. We've talked about the US dollar in past videos and how overbought, oversold it's been. Really pushing, the US dollar broke out today, and really pushing it on this new up leg is euro weakness. The yen, which was seriously weak in recent months, at least that weakness looks to be arresting to some degree. So as far as when might the dollar have this peak, obviously that's going to depend on the euro, which is, as we said, is really driving this leg of the dollar higher. And so in this chart, we look at some momentum indicators and looking at the euro's distance from its 20-week EMA, exponential moving average, 40-week EMA, and then the 80-week EMA. And right now, the euro, or I should say a couple weeks ago, the euro, as far as the distance from its 80-week EMA, was at possibly an all-time high. Now, we can see the euro is not as oversold when you're looking at the 20-week distance between where it is in the 20-week and where it is in the 40-week EMA. Looking at those, the euro was closer to the second or third most oversold point. But again, going back to the 80-week, I mean, that's basically there at perhaps the lowest point ever, or at least is extremely close to it. And so I've gone and I've highlighted these extreme oversold points in the euro. There's one in 2010, one in late 2008, a couple there in 2000, and then one in 97 and one in 93. And I've highlighted there in yellow how the euro performed after those periods. And we can see that the euro performed very well in all these periods. Now, I looked at 2000 and I put the arrow there because that's when the euro became extremely oversold on a long-term basis. and we can see the euro had a sharp rally there and then plunged to a final low. So that's something to keep in mind. It's possible that the euro could have a sharp rally and then go lower before it makes some kind of major bottom. But in any event, and I'm not going to discuss sentiment because no matter what you look at, it shows that sentiment on the dollar is extremely bullish and on the euro it's extremely bearish. But in any event, in all these cases, the euro had a really strong rally, except for there in 2000, 2001. But that extreme oversold point there in 2000 was in May of 2000, and then in November 2000, which is 5 to 6 months later, that's when the gold stocks bottomed. Then a couple months after that, gold bottomed, and then of course hard assets performed really, really well. The stock market also was in a bear market at that time. So that's something to keep in mind as far as a potential similarity to today's market and what could happen in the months ahead. And so getting back to the gold stocks in the last couple days, they've started to break down again. And here we're showing the gold miners index. This is the forerunner to GDX. So I like looking at this because it has a much longer history than GDX. And this is a weekly line chart. We can see that it closed at about 558 today. And looking at the yellow circle there, you can see that strong double bottom on the daily chart, it shows up a little bit there on the weekly chart. But the major weekly low is about 480, and then the second low, which happened, the first low, I believe, happened in November, then the second low in December. The second low happened right around 500. And so looking at where we are now, I mean, if this market continues lower, which it looks like it will, I mean, an 11% decline from here would put it down around 500. So that's support to keep in mind. And then it would have to decline about 18% to test the daily low. Again, this is a weekly chart. We're just using offhand data, but the gold stocks would have to decline, based on GDM and GDX, 18% to test the daily low. So, and obviously the short-term technicals are negative. So keep those support points in mind. But also keep in mind the huge decline in oil prices and the weakness of various foreign currencies. So obviously, as we've said before, those factors they can be really favorable for some companies and only slightly favorable for other companies. But I think on the whole, it's a positive fundamental development for the gold stocks. And so that's just one reason why I think they're not going to go to a new low. But whatever happens, I mean, obviously opinions can change, but looking at all these factors, I think in the next couple months, gold stocks are going to form some type of double bottom here, and it looks like they could potentially form a really, really strong base. And then if you get that change in the currency market that we talked about, and then the stock market starts to peak and begins a correction, that could set up for what we've sketched out here, which is a really fantastic rebound in the gold stocks. And I mean, just to give you some information as far as how much they rebounded following the 2008 and 2000 lows, in the first 6 months after the 2000 bottom, the Huey rebounded about 100%. And I'm using the Huey because it's a little more volatile than GDM. Go back to the first 6 months after 2008, the Huey rebounded 126%. But more importantly, after the first 18 months of the 2000 low, the Huey rebounded 311%. And following the first 13 months after 2008 low, the Huey rebounded 237%. So I see some huge potential gains coming. It looks like here in the second half of 2015 and then into 2016. Of course, things are subject to change, but that's how things are setting up now. Be patient and let these miners potentially fall down here to strong support, and that could be a tremendous buying opportunity. Thanks everyone for listening and watching. You can follow my work at thedailygold.com. And thanks again, and I wish you all the best in 2015.